Well, good morning, everyone. It's a Monday. What a Monday it's going to be. Oh, man. We had an eventful Friday, Saturday, and Sunday um, in the world of economics and banks and, all this stuff. I feel like most people, those of you watching included, probably know that this week we had two banks fail. Last week, I should say, unless you count Sunday as the first day of the week. And so last week, Friday, SVP, Silicon Valley Bank, uh, failed, went into receivership. And following that, SBNY did the same. And this has been quite interesting because what the Fed does and what happens next is going to tell a lot of the story of what's going to happen with our economy. Now, what's interesting is what the mortgage market is doing today, which is it's positive. And we'll get into that. But let's talk about this a little bit. Let me preface everything that I'm about to say by saying I am just a loan officer. I'm not an economist, but I've read up on this issue. I've watched a lot of videos. I've been following it. And I want to try to put it in layman's terms for the people that pay attention to what we do and what we talk about. So how did we get into this situation that we find ourselves in with two banks failing over the weekend? So to understand that, you have to understand fundamentally how banks work. Now, on the face of it, banks are a simple operation. Money comes in, and then they lend the money that comes in out at a higher rate than the money that they're paying that comes in. That creates their profit margin, and that is how banks are profitable. Now, you add into that these days, they make money through other revenue sources, be it swipe fees or, all that different stuff. But at the end of the day, banks are profitable based on the money they loan out. Well, the situation with Silicon Valley Bank, and from what I understand, SBNY, very similar. And the Fed is also assessing other banks who may be in a similar position. They were not lending money. And the reason they were not lending much money is because they worked with tech startups. And these people are typically flush with cash because they're getting VC-backed funding. People are buying into these companies. They're flooding them with cash. Tech startups notoriously burn through cash. Most companies it's very difficult for them to be profitable. You can see this in our industry with Zillow and other companies like that. They don't typically turn much of a profit because they are VC funded. Now, Zillow went public and whatever. We won't get into that. But because of that, SVP and other banks are not. What's up, David? So SVP and banks are not lending out money. They're not lending out money. So they had to now figure out a way to make more money on the money that was coming in than they were having to pay out. And what that created was a situation where SVP went in and they bought bonds. And they bought long-term bonds, and they started buying these bonds back in 2020 and 2021. Now, the issue is that as we sit here in 23, the bonds that they bought in 20 and 21 are practically worthless. They're not worthless, but they are diminished greatly upon their value. And because of that, they are losing money. Now, you add in where the real issue comes from is in reserve requirements that banks are required to have. Now, we could dive deep today, and I'm not going to, in the fact that our economy and our banking system is built on a fractional reserve philosophy, meaning that banks don't have to have a one-to-one ratio of money in deposits and money lent out, right? So your bank can lend exponentially more than they actually have in deposits. That's the way the fractional reserve system works. That's why you see things like the FDIC in place where money is insured, so on and so forth. What happens is SVP no longer had sufficient reserves because all of their capital is tied up in losing bonds because the bonds that they hold were worth less than the bonds from the current market. It only took a few people, and here's where things get interesting. Sorry, let me get rid of that. Here's where things get really interesting. It only took a few people within that bank to panic and withdraw their money, and it creates panic withdrawals, which we call a good old-fashioned bank run, like we're in the 1920s. We're in the 2020s, but apparently we're going back to the 1920s. Please, can we keep electricity and running water? That would be great. So they run the bank. The bank doesn't have the cash to survive these withdrawals. Again, fractional reserves that don't have enough deposits. The bank collapses. So whose fault is this, right? Don't pass up an opportunity to pass blame. We're not going to do that, but we are going to do that a little bit. Let's talk about, is this bad lending policy? Is this bad credit policy? Is this bad banking? Or did the Fed cause this? Well, what you have happen, to understand truly what's going on here, again, I'm not an economist. Somebody may pop on here and say, dude, you're an idiot and you're totally wrong. This is what I've gathered. To understand this, you at least have to go back to COVID. Now, what the Fed did during COVID was overstimulate the economy. That's why we have inflation right now. They overstimulated the economy by just gorging themselves on mortgage-backed securities, just buying them all up. That drove rates way down 2 to 3%. Demand increases, supply decreases. So now you have this housing market bubble. To add to that, they then start giving everyone or almost everyone free money. So you flooded the market with money, you have increasing demand, and you've made mortgage rates all-time lows. And this overstimulates the economy. And so anytime you do that, there's this little known guy called Mr. Inflation, and he wants to come and join the party. He hasn't been able to join the party for a while. He wants to come in and join the party. And so now the Fed has to create policy to curb the inflation. And the Fed's policy to curb inflation is to increase the funds rate and, as a result, increase rates for lending. Unaware, I don't know if they didn't see this coming, because of how quickly, this is the fastest they've raised the rates in the history of time. As I'm distracted because as I'm talking, I'm watching the market, and mortgage rates are getting even better than they were when I started 5 minutes ago. So they create a situation where the rates, which are bonds, which are treasury bond, like all this stuff, they've raised them rapidly. And so what happens now, because of their plan to raise rates so rapidly, we're sitting at 4.5% Fed funds rate. We were much lower than that when we started. Bonds invert. Short-term bonds become better paying than long-term bonds, which is crazy. So I don't know if you can blame this solely on SVP or SBNY for bad monetary policy or bad banking policy. This isn't a situation where these banks were making bad loans. In fact, they weren't really making loans at all. They bought into bonds, they bought into mortgage-backed securities, and the bonds that they bought into, we're talking billions, or at least $1 billion, were like worth now 70 cents on the dollar. And so when people start withdrawing their money, they cannot support it, because now they don't have enough reserves. So SVP's issue was that they weren't able to lend money. And really, in my opinion, in the opinion of many experts, the situation that we find ourselves in is the Fed's fault. It's their way that they've managed this and that they've handled this. It's their fault. Now they have to thread the needle even more difficult, which is already hard to do. And so they're coming out and they're creating a system where they will make depositors whole with SVP and SBNY. And really, that's the only choice that they have, because otherwise, and this is so important if you're watching this, otherwise you have massive bank runs. Now, let's understand bank runs, meaning that a large amount of depositors flood to their banks to pull out all of their money so they can have it in cash because they're worried the bank's going to go under. It doesn't take a lot of people doing this. So be very aware of the media talking points this week, because I believe that when you click on CNBC or Fox Business or the headlines of your nightly news, you're going to see panic and fear-inducing headlines, and that could trigger people to run on banks. So now what the Fed has to do because of this is create a situation to tone down the fear and say, hey, we'll make you whole because you don't want a banking system collapse. Like, you don't want that. But the Fed has caused this. So we got bank failures. We got good old-fashioned run on banks. How in the world does that result in us being up almost 120 basis points on the day of mortgage rates, which is the best for sure all March, and the only time better was beginning in February, and we may see those numbers again? How does that happen? Well, the Fed, Jerome Powell, those guys, their policy has been to rapidly increase the federal funds rate. And after the inflation reports came in February and jobs gained, although those numbers are very questionable, I haven't talked about that, but the way that they calculate those numbers is questionable. So there was a job gain, not a job loss, which the chairman has said multiple times that he feels like the only way to curb inflation is to see a reduction in the workforce. Basically, people lose their jobs. We began to see rates creep up higher and higher, and that was because there was speculation in the market that the funds rate would be hiked to 5, then 5.5, and things got all the way to where they anticipated a fund hike up to 6%. Well, the market didn't like that. Rates didn't like that. And so we went from middle fives for us as a broker. For your other lenders, it was 6 to 7s, high 6s, low 7s, and then, sometimes high 7s depending on credit. So why now? What's the change? Well, the Fed almost assuredly, because they've come out and said, we're going to backstop this, we're going to protect the depositors, they almost assuredly now have to stop their rate hike. The Fed meeting is today. And so now, instead of there being fears of a 50 basis point hike or a 75 basis point hike, we could see no hike. We could see a 25 basis point hike. And the markets are loving that. And furthermore, they may have to reverse course. They may have to say, not only are we not going to make a hike today, we're going to reverse course and go back to 4 or 4.5 or whatever it is. And the markets are loving that. So stay tuned. If you're shopping for a house and you're going under contract this week, it's going to be a good week for you, I think. Now, inevitably, they could come on for the meeting and say things that totally eradicate this positive 122 basis points that we're up right now. And I don't think that lenders are going to immediately give this increase back to the consumer because there's so much volatility and unknown. We may have to see this trend go on for a day or two before we see this come back. Some lenders are more aggressive than others, and so you may see it. Others maybe not. But that in a nutshell is where we're at. We were already expecting somewhat of a betterment of rates, hopefully today, because we were hoping that the CPI and the inflation reports would be positive. We were hoping we got a positive, but not too positive jobs report last week, and that we saw some positive rate movement. But this has nothing to do with that. The betterment that we're seeing today, it now makes this almost irrelevant because what the market is saying is we think the Fed's going to stop the course that they're on and potentially reverse it. And if they do that, that has a huge impact on mortgage rates, on the housing market, and on the economy. How we fight inflation from here, I don't know. But that's what's going on. So I would say if you're in the market and you're shopping, hold on, rates are getting better. I would also say be very wary of buying into the fear headlines of bank runs. From what we've seen, this is an issue with a certain amount of banks who were not able to make loans due to their clientele. And because of that, they had to go in bonds. And then the feds basically undermined their own banking system. For most banks, your big capital ones, your JP Morgans, your Wells Fargo, they're well capitalized and they're not as involved in bonds because they're lending their money. So be very, very wary, I should say, of buying into anything about running on the bank and trying to pull your cash. I mean, the vast majority of people have less than $250,000 in their accounts anyways. So, but anyways, I'm just one loan officer dude who wants to just bring this to your attention. I know that fear sells more than facts, and so hopefully we can take some facts from this and avoid some of the fear of withdrawing and freaking out, and we can actually make sense of this. I'm learning with you. If you have any questions about this, drop me a comment, shoot me a DM. But happy Monday, everyone. I think we're going to see better rates. Thanks, guys.